Joining us right now in the markets is John Mowrey. He is NFJ Investment Group CIO and Senior Portfolio Manager. And John, I'm wondering, what are you hearing from your clients at this point? The market's been whipsawed. We're all over the place. What kind of questions do people have? And what do you tell them when they come to you and ask what to do?
Great question. There's two big concerns right now. The first is tariffs, and the second is what's going on with the national debt. With regard to tariffs, I'll start there because I'd like to discuss both. Tariffs are very simple. They're just a tax. There's only two ways a company can deal with the tax. They either push it through to the end customer or they absorb it in their margin. And to be honest,
they eat it.
They eat it.
President Trump says, right?
They do. And I'll be honest, I empathize with President Trump because there's no company that has a mastery of the supply chain more than Walmart. But I really didn't like that he said that they should eat it because when you go public, you subject yourself to a whole nother group of shareholders. And the shareholders get to decide. Management, if they want to eat it, that's going to drive down the stock. So I really didn't like that he said that. And I think that undermines the very nature of capitalism that is embedded in public equity markets. So when I look at what's going on, I think that there are opportunities being derived from what's going on with the variability of earnings because of tariffs. So, for example, apparel, autos, industrial machinery, these areas are being impacted by what's going on with tariffs. But I think that creates opportunity because of the uncertainty around the earnings variability, and you're getting much lower multiples, Becky, in these areas today.
Okay, I was just looking at the Walmart shares. We had it up. Those shares are up. I didn't realize 10% since the Trump tariffs were enacted. On some of these things, too. It's up 10% year to date, but I believe we just showed a chart. If you can go back to Walmart since the tariffs began.
Yeah, it's really interesting how markets react to things based on what people say and then what actually occurs. I mean, Walmart, again, they haven't done that, right? They have not chosen to do that. So, I mean,
Walmart's been the ones that went to China and said to their suppliers, you're going to have to take a lot of this on, and they've been pushing back on any price increases coming through.
They're probably in position to handle it better than anyone, but the S&P is almost at an all-time high.
It is, and I think that there's a lot of positives.
Not just Walmart.
Yeah, Walmart's a big piece of that, and the mega caps have carried it. I mean, this has been a mega cap trade for a long time now. In fact, I was going to mention this because since the end of 2020, the S&P is up 70. Small caps are up 7. So this has been a mega cap rally. Money's just flooded into the big companies. Yeah. They've been impervious to all of this. And it makes sense. They can deal with tariffs so much easier. They have so many levers to pull.
This reminds me of COVID when the small companies really struggled and the large big boxes were allowed to stay open.
It's true.
They're going to be the ones that have the advantage.
It's true. It's true. So they're benefiting from this. But I think that has created opportunity when you look at other areas. I want to touch on debt. Can we talk about the debt for a second? So I hear all these people, and they're all talking about that the reason rates are up is because of the deficit and because of debt. And, Joe, you've made the point that interest rates have just really normalized. So I want to make a couple observations. Since 1960, total debt for the U.S., the CAGR for that is 7.6%. That's the growth rate for the U.S. debt, okay? If you look at the defense budget, I hear a lot of people saying, well, we're spending as much on interest as we are for the defense budget. Well, the defense budget grows at 4.5%. So it makes sense that we would spend more on interest, particularly when rates are up. And when I think about how America likes to spend its money, there's lots of things we spend money on. Interest rates are just back to where they were in 2006 and 7, around 4.6. And if you look at the median going back to 1980, that's including when they went to 15%, okay? Right. You're right at the median. If you go back to 2015, 2016, there was an article in the Wall Street Journal that said that the Danish, okay, had floating rate mortgages they had taken out, and they were getting paid interest. This was insane. It was totally insane what was going on with low rates. Rates have normalized. So I don't really buy that the reason that rates have normalized is because everyone's worried about deficits and debt. And I think there's another way to think about U.S. debt. And that is, if you look at the total debt divided by the total market cap of the equity markets, it's 70%. It's much lower than actually a lot of other countries around the world. And our country is made up of companies. It's just like a university. A university is nothing but a bunch of buildings, right? But what makes it a university is the people that go there, the students and the faculty. That's what makes Harvard. That's what makes Princeton. That's what makes all the schools. This country is just a group of companies, and it's what sets us apart. And I would argue that just like
So you
Japan,
think it's okay to continue to grow our debt?
well, I'm just being a realist. If you look at what's going on with
either way, I guess.
well, okay, I'll make this point. Trump's bill adds 30 to 50 basis points per year to the national debt. That's actually lower than the long-term average. The long-term average has been higher. It's been more like 100 basis points. The reason for that...
But we've blown out the debt since COVID.
We have. We added $6 to $8 trillion. But, Becky, even with that, the CAGR has been consistent. We like to spend money here. We do. And the markets tolerate it because we're the reserve currency and going back to the companies.
We do it because we can, but...
Let me counter that with something that Geiger Capital posted yesterday. I haven't checked their math on this, but Geiger Capital's account said a million seconds ago was May 23rd. A billion seconds ago was 1993. A trillion seconds ago was 30,000 BC. And by the way, the U.S. national debt is now rising by $1 trillion every 180 days. Right. I hear what you're saying. But if you get to 120% of GDP,
we're going to 150.
If you start to get to those numbers, it does seem like you're going to risk at some point Treasury buyers saying no mas.
I agree with this.
And the dollar will be worth the same as the
dollar's been under pressure even as our Fed has kept rates high and other central banks have cut throughout this year.
Well, the dollar was the highest since 2002. Okay, the dollar was the strongest since 2002. So the dollar was weakened recently, but I want to be very clear. I like cutting spending. I'm not saying we don't need to not cut spending. We should cut spending, but Japan, let me touch on Japan. Everyone says Japan is the outlier. They have debt to GDP of 250%. The U.S. is 120%, right? Going back to 2007, we were 67. So if the capital markets were really worried about the fact that we've doubled the debt to GDP, okay, then why are the yields at the exact same level that they were 15 years ago? Japan is considered an outlier because, okay, people say, well, they buy all the JGBs, the Japanese government bonds. They buy them, so that's why it's an outlier. So all the economists say that's the reason. The U.S. is also an outlier, though, because there's no other country in modern history that has done what we've done. We have companies that mushroom. The ownership interest in companies and the capitalistic model here is totally unique. I don't think there's any comps for it. So I don't think that we have as big of a debt problem as people say, because I think that the borrowing capability of the U.S. is far superior to what people realize.
It almost sounds like MMT and American exceptionalism, which I agree with a lot, obviously.
The American exceptionalism part, not the MMT.
No, I don't agree with MMT, but I see what you're saying. But that is the basis for MMT, that we can always we're always going to be able to sell our debt, no matter how much.
I mean, Joe, I want to be an idealist, but I have to be a realist.
Right.
The CAGR is 7.6. It's been 7.6 before COVID. Yep. It's accelerated a little bit. The bill is going to increase it a little bit. The deficit's bigger. But I say this, I'm like, well, the deficit's bigger. It's like, well, yeah, the deficit's bigger. But did people think it's almost like teaser rates when the 10-year was at 63 basis points? Nobody thought this was going to happen. It's like, I remember in The Big Short when they're like, oh, you think the rates were going to stay there forever? I mean, come on. Rates normalized. They went right back to where they did. Mean reversion is at play once again. And that's why I like some of these other areas going back to in the stock market. Where's opportunity? There's big opportunity for mean reversion. And it's in other pockets of the market that have not participated, like the big growth names over the last 10 and 15 years.